Hello, everybody. I'm your boss, Joe Boss, and welcome to another daily plan. How low can you go into FOMC? Man, PPI came out today, and we jumped here. And then we got some oil news that came in. Let's go ahead and check that out real quick. Oil did pretty well today and yesterday on new information of more demand and lower supply. And it looks like oil is probably going to end up doing A-okay going into the end of this week and likely nominally into next week. There's a lot of people eyeing the $85 level here on oil. So that'll be good for oil producers. In fact, arguably a higher oil price is frankly okay for the US dollar because a lot of oil now gets produced in the US. The US dollar becoming kind of a commodity currency. But there's a more important thing to watch out for in the near future when it comes down to the dollar, obviously, and that's FOMC. So for FOMC, I'm still in the camp that they're going to show usually like two dot plots saying, hey, well, the dot plots will say, hey, we're going to cut maybe 2 times this year. But now I'm starting to move into the camp where if data continues to improve going into the summer, by the time that first rate cut is done, that the market's going to move to anticipating at least 1 or 2 more rate cuts. Again, I think there's more of a risk that the Fed stays too tight than too loose, frankly, for this year, that is. Now, for next week, I'm starting to eye the next week's probability pivots, the seasonal data, and the ranges for closes into the end of this week. So how is this week going to close? What are some general ideas of how next week could perform? So let's get into that. As far as how this week could close, most of the time, close to 28, 29% of the time, close this week on the dollar is somewhere around here. So the fact that we got this jump here on PPI, yeah, it's here. But if I could pull up the economic calendar and go, oh, hold on. Forgot to mute my research notifications here. Getting a few emails of outlooks for the week ahead already. A lot of people already sending their FOMC analysis out. So check this out. PPI month over month, actual 0.6, forecast 0.3. So that's higher. Year over year came out higher. Like that's a bit of a reacceleration on the PPI, the producer's price index. PPI excluding food came out a bit higher year over year, lower than the prior month over month. So PPI excluding food and energy is sticky. It's holding up. But the headline figure is what's caused this jump. Now the question is, does this PPI figure here justify some massive reversal from this trend here that we've had from effectively the month prior? And I'm not too sure. I think short term, going into FOMC, will at this point now see some more risk off, potentially much higher dollar, but I'm still kind of skeptical on how much more upside this dollar is going to get. And maybe you can see that when I look at these next week's seasonal probability pivot ranges. You have kind of two regimes here. You have this area. Oh, I tried to. Oh, my trading view is lagging quite a lot here. Now suddenly I can't drag it. Hold on a sec. Let me try reloading the tab. Yeah, save and reload. All right, saving, reloading. All right, got some alerts in. And there we go, we're back. So I see two spots here. We have this spot where you get a lot of your bullish closes next week. And then you have this spot here where you get some of your bearish closes. So if FOMC turns out well, you could probably tap this 104 spot up here. It's quite a move up. And then move lower into the close. And just to illustrate, it'd probably look something along these lines here. So up into some high. Go ahead, color that one green. This would be the bullish scenario. And then down into a likely nominal close. Now, because we already have expectations of 2 rate hikes, or rate cuts rather, going into this year, and that's been getting lower and lower and lower since the fourth quarter of last year, I think the risks now are that we are probably looking at too tight of monetary policy, and that we'll probably see 1 or 2 more rate hikes, rate cuts, come in, get priced in as we get to the end of the second quarter into the third quarter of the year. Now that's quite a ways away. So there's a risk here of some more dollar upside if there's no improvement on inflation. So while the CPI was mixed, yeah, it was sticky, I wouldn't call it hot. That PPI was hot. That PPI definitely was hot. And you got the move out of it, sure, but now it's a matter of, do you continue to see that? Remember, one of the things that I've been talking about the last couple of days is you have to see the bad data before you get bearish. And yeah, this PPI I'd consider bad data for people who are trying to go risk on. But I wouldn't necessarily call it the end of the world, you know? You get one bad metric and all of a sudden now you're gonna think, oh, we're gonna go higher in dollar bullish all the way up into the next, into the June meeting, all the way up into May. It's like, no, you have 2 more PPIs to go through and 2 more CPI reports to go through, and you have all this other extra economic data to go through. And there are risks to those things coming out higher, for sure. And there are some leading indicators that can help give us some insight into how those inflation metrics are going to print. But until you actually get those metrics, it's still in my mind a bit too aggressive to say, oh, the US dollar is gonna, go to like 108 or something nutty, or crack this high. It's too early to say that right now based off what I'm seeing. But with this positive move in the BPI coming in, the BOJ just today entered their blackout period, so no more commentary out of the BOJ. However, we did get some news actually out of the BOJ saying, oh yeah, we're going to do our rate cut next week. I think that was a press test or something. Someone leaked it on the start of the blackout period saying, oh yeah, we're going to cut. So this is dollar yen. Again, my expectation is this thing's going to end up closing sideways. And then once we get into next week, it looks like most of your closes are here in this area. So it's like a 200 pip area between 149 and 147. So this is kind of the playroom of, where are you going to end up closing? And most of these prices are actually going to probably be below the closing price of this week. So I'd probably expect some sort of up move into FOMC, some sort of spike, some large top wick on the day of FOMC on the announcement. And then going into end of the week, you're going into a more nominal range. And then throughout the rest of the month into end of March, maybe first 2 weeks of April, my current expectation is still for some more dollar weakness because I'm optimistic about inflation. That even though it is sticky, it is coming down. And that the rest of the world is going to continue making economic improvements. So it's more or less a matter of, does that idea actually hold up? Or are we going to get something nutty like the FOMC is super hawkish and says, yeah, we're probably going to do this one cut and in June, and then we're going to hold off. And then all of a sudden you're starting to see in the Fed dot plot one cut, which would be really tight, really insane. And I think that might justify closing in these spots up here next week. So particularly hawkish FOMC gives you the risk, I think, of closing in this close to 150, 151 spot here next week. Again, those are low odds, and I think the chances of Fed being that hawkish next week are pretty low. But it's important to, hey, if you're short the dollar, I have a bearish bias on the dollar, that you have to look at the flip side of the coin. Hey, what can go wrong? When do you update and change your expectations? What sort of information do you need to see? What are the likely economic values to come out that if they came out higher or lower or surprised in some way would actually change your mind? And then as soon as those things happen, make the decision as quickly as possible. So that then you're not either holding a bag, or so that then you're not getting out of a good position sometimes too early. Let's head on back. Actually, let's go ahead and check out euro dollar. I went ahead and let's see here. Yeah, I timestamped this one here because I'm like, that PPI comes out nominal, which this one definitely did not. We'll probably continue to see sideways drift, and there's some positive upside. Looking at next week here on the euro dollar, this is a big fat range here. In my opinion, this is a big old guess of where the close is going to be next week. This is a big old guess. It looks like, let's say we closed at the current prices we were at right now, then this set of pivots would be stationary, it wouldn't move. And then we can go ahead and count, okay, what are the chances of closing below the current price? What are the chances of closing above the current price, given the current seasonal statistics that we got for the next week or for the last 21 years? Well, that's about 70-30. It's, yeah. Actually, it's more like 20, it's closer to maybe like 35-65. So somewhere kind of in that range, 65-35, where 65 to 70% of the time you're closing in the green next week, and 30 to 35% of the time you're closing in the red next week. Now, next week, we also have European flash PMIs, and if those continue to improve, this asset might have an end of week recovery. So while I'm not going to draw my week ahead expectations right now, that'll be for tomorrow's show. Friday is the week ahead trade plans stream. That's when I'll go ahead and set my week ahead expectations. And right now, preliminarily, as I kind of ingest this PPI metric and what's going on in gold and what's going on in oil with the supply and demand dynamics there, my expectation is dollar strength into FOMC, and then on the day following FOMC, or in like the 24 hours following FOMC, that you flatten out, and then into end of week, you look at what risk on events could be around for an end of week recovery, and then you watch those. Because if those don't do well, we could end up with a particularly strong dollar going into the end of the week. And then the dollar here could like legitimately have a very, very strong chance of just recovery going into the end of March, beginning of April. So it'll be interesting to see how the economic results come out towards the end of the week, post FOMC, how hawkish FOMC is. And actually, even short term, I can see this on the economic calendar. This is all a bunch of European inflation metrics. So there's France, there's Italy. Let's see here. Anything else? No, just France and Italy. I don't know if that's going to help the EU or not, frankly, just when you have the final numbers coming out here. Unless there's some major revisions, frankly, to prior numbers, I don't see these things moving, at least the euro-dollar exchange rate or European equities, all too much. So yeah, we got some uncertainty about where next week is going to end. And as far as this week so far, I think it's going to be pretty flat going into the end of this week from here. Not much more on the docket here as far as economic data goes. Yeah, you can see the PPI came in stronger, so we ended up missing this upside expectation. And maybe it recovers and still closes in this sort of nominal range where you find a lot of your closes. If I could, real quick, go to a 12-hour chart. Yeah, there's... I can see, at least here on the Aussie dollar, the negative drift potentially coming in here. You have some closes right here in this little blue spot right here that I'm hovering over and moving my mouse around. So there's kind of two regimes here. Either you get your close around here, which was kind of this plan, you get your high over here, and you close back down into this peak over here. But that PPI has now said otherwise. It said, hey, instead of this more nominal, neutral, range-bound peak, where we get actually most of our closes for a given week, we're going to go ahead and shift prices down, and we're going to close somewhere around here. So that's the more bearish closes. So I'd say when you frequently get a bearish week, you're on Aussie dollar, it's probably going to be somewhere around here. And that seems to be the case. However, it's not that crazy of a move. Let's see here. From the open to the close, you're talking 40 pips. I don't know, maybe it keeps going down and you get 60 pips out of it for the week. So it's not a particularly volatile move compared to like what we had back here. This was some really, really good trading for risk-on traders. This isn't necessarily, if you're a dollar bull, really what you want to see going into the end of the week. You want to see the kibosh come down and this thing tank lower. But the only really bad news you got was this PPI. What you really need next week is a super hawkish FOMC. And then for that European data to actually come out worse than expected towards the end of the week. And then, I don't know, who knows? Maybe there's some more commentary from OPEC and Russia on how tight they're going to be with their supply. Maybe they'll go ahead and surprise us and cut more, but it doesn't seem like that's going to be the case. They are keeping their supply constrained, and demand, they are putting forecasts out saying demand for oil is growing, demand for energy is growing. And I don't doubt that if the world economies are recovering, the demand for energy is going to increase. And if the supply stays the same, you're going to see an increase in price. That's just how it's going to go. And that ultimately can lead to a reacceleration in inflation in Europe, if that is the case. So there's an interest in increasing supply of energy, and hopefully we'll see more LNG and oil rigs, at least in the US, come online to try and keep those levels low so that then we can get inflation to recover from these high levels going into the second half of this year. I'm just not so sure with the way the whole geopolitical landscape, politics is laying out, that we will get those initiatives. So I have a feeling that supply is definitely going to be more constrained as demand begins to recover going into the second half of this year. And that could cause a reacceleration in inflation in some places and make it harder probably for Europe to get their manufacturing back online. Remember, Germany's like sick man of Europe right now still on their manufacturing end. And yeah, across all the dollar pairs, you're kind of seeing the same thing. So here's the bearish closes on the ranges. We can go ahead and pull up the closing odds here. Wow, next week a lot of your closes are around there. So it's nominally flat, nominally neutral there for next week. Let's go ahead and check out the pound. The pound, most of the closes are here, but wow, check that out. A lot. It has a bit of bullish skew there, huh? Doesn't look so hot, in my opinion, on the pound for next week. Yeah, this is a big ol' range. Look at that. 126.7 to, I don't know, roughly 128.3. There's a lot of risk of some crazy volatility around next week here on the pound. That's going to be kind of scary for guys who are holding on for dear life, like around these prices on longs. They could definitely get tapped into around those prices. But who knows? Maybe they got some more money on the side and they see the economic recovery on the bend and they buy going into end of March. I mean, we're gonna have to actually wait and see. Again, it's not just, oh, you have to set some sort of expectations. You got to understand the expectations of the bullish and the bearish and the neutral traders and see what's most likely. And then when you have those expectations, you have to see the good data come in, good or bad. So the guys who are sitting pretty long all the way over here on the pound, they actually have to see good data come in here, because otherwise just the policy and the growth out of the United States can crush this pair. So there's a bit more work on the pound side that has to be done economically, where you have to see that regrowth, that positive growth come in, actually come in. Because all things staying equal, this thing's going to go down. Let's see here. Any other major? I mean, there's the dollar yen too. Again, I'm a bit more skeptical here on these dollar yen up moves because the BOJ is hiking. Like that's kind of 100% priced in, close to like 95% priced in at this point. And we just had a press test talking about how the BOJ is definitely going to hike at the next meeting. So as the Fed's going to lay out a policy for how many rate cuts they're going to do, and they maintain their policy flat, Japan's hiking, and Japan's economy is recovering. Actually, a big portion of that recovery is from tourism. They're doing pretty all right. They are having some problems in their economy right now, kind of with the trade houses, you know, the sector that Warren Buffett invested into, and their banks. It's kind of weird. Japanese bond yields and their central bank rate are going higher, but the prices of the bank sector equities are going lower, which is kind of interesting. They just want more people to spend and spend and spend in order to kind of how their economy works. That's how they want their consumers to behave. They want them to spend more. But they have a similar issue as in China, where their population's kind of getting a bit older. The people who do have money don't really want to go out and spend so much of it. And a lot of Japanese investors are still focused on overseas stuff, to be frank. So we'll have to follow up on Japan once we start walking into BOJ and FOMC. A lot of the analysis today is going to be hung up on what's essentially going to happen post FOMC. We have very good expectations, consensus expectations of what's going to happen. It's just now a matter of, okay, how are prices going to react to that information? Is it going to be particularly volatile, or are we going to have super high top wicks, super high bottom wicks? And then what's the data in the latter half of the week going to look like? And then what are the next set of inflation reports going to look like? And there probably will be some opportunities over the next, I don't know, towards the end of next week, maybe the beginning of next week, to take advantage of those expectations, because we'll also be getting some month ahead expectations probably in that 2-week period from now, right? So somewhere around here, where my mouse is hovering over, around these dates, we'll start to get month ahead expectations, and that will maybe be right here at the beginning of that following week. So we'll get some updated expectations for how April will play out, how inflation's likely to play out, what are some of the risks that we should be aware of. And there's not too much really to think about right now other than, you know, if you're short dollar, to either hold on for dear life or trim positions, because the risks of going higher, just at least into FOMC, are pretty great if you look at market pricing. And then there's uncertainty about how the end of the week next week is going to play out. And then it's not going to be until now that we get some more stable expectations about what, or at least some preliminary expectations about what March's inflation is going to look like when it prints in April's CPI report, at least in the US, and then for the rest of the Eurozone. Yeah, we're really going to have to take the next 2 weeks really step by step. Like, we're going to have to kind of hold our horses on being like super aggressive. Now, I'm still going to be a dollar bear, to be frank. But tactically here, there are imminent risks, and this PPI jump makes it more risky. And I wasn't expecting this PPI jump because that is a risk. The way that PPI printed today was not good. That was bearish. And because we got that, it's really put all these prices in worse positions for people who are holding onto dollar shorts who are anticipating an economic recovery. It's going to put them at some more risk. It really just depends on what their risk tolerance is. Some of these guys are sitting in the money and they're going to be holding onto those trades, and they have to be willing to either get out when the bad information actually comes out, or they can trim now, and if there is a potential drawdown to their positions, just reposition higher with the money that they earned from trimming their current in profit positions. So there's all sorts of ways that people can look at the current environment and manage their positions, but that really is going to be dependent on the asset you're looking at, because there's a lot of idiosyncratic risks going around, because how one, at least in the FX space, you're essentially looking at, in this case, dollar CAD. You're looking at how the US economy is growing relative or moving relative to the Canadian economy, or how the FOMC is moving relative to the BOC, or how US inflation is moving relative to US inflation. It's nothing here too much on the yield spread side of things. This is it's not going to be easy to just look at one asset and say, okay, this entire asset class goes up or down now. Like, you have to be aware of the idiosyncratic risks of each asset you're looking at, because the rate of change for all these individual countries is performing uniquely. And the same thing goes for a lot of the equity sectors that are in these countries. So at that point, you have to take into account the rate of change of economic growth in all of these countries, and then look at the rate of change and growth and the high frequency economic data for these individual equity sectors. And now you can see just the level of complexity of, for example, managing a portfolio and actually talking about these things gets really complicated really quick. Again, my expectation, at least into the end of this week, is effectively sideways from here after the PPI. I was a bit concerned that, hey, if this PPI, concerned might not be the best word, but I was thinking, hey, if this PPI still just prints nominally as forecast, this puts all these USD pairs in a particularly good position, because all the guys who are short dollar are going to feel pretty okay, even on like 100 pip, wick to the upside, or a 80 pip move to the upside on the announcement of some hawkish FOMC announcement. But now with this PPI move higher, and even though it's like 30 to 60 pips, depending on the asset you pull up, it now puts some of these positions that people are trying to hold on for a short dollar play kind of at risk of drawdown. If there's no follow through on dollar weakness into the end of the week. And there's no guarantee you're not going to get that dollar weakness in the end of the week. Onto commodities. Gold is holding up really, really well. I mean, yeah, the PPI came out, but it's like, okay, what you got next? And I'm not totally sure FOMC is going to make any more of a significant improvement. I think that we're going to begin to establish some sort of range here at these prices, kind of plus or minus $50 from here. I don't see too much trend coming in lower from here. I think we're going to begin establishing a range going forward on gold. And gasoline did really well. Oil did really, really well. Actually, let's check out the high odds here. Wow, that is the 75th percentile here. That is pretty darn high. Yeah. Another thing to point out with these risks is, hey, once you're starting to go past this spot here and you're dealing with these very flat looking bars here, it just says that all these probabilities are very similar to each other. You can see they're all like within 0.5% of each other. So figuring out where the high on oil for this week comes in once you start trading above here, it essentially becomes a big old question mark, becomes a big old guess. And yeah, that's why you stay aware of, hey, there's risks of a pop here. I'm gonna be careful going into any more bullishness here if you're oil short, right? I was particularly bullish on oil, and then I was expecting some recovery into end of week around here, but this thing just went pop, pop, pop. I'm like, oh shit. Didn't update my expectations fast enough. Wasn't again, those EIA numbers came out. We looked at them. Yeah, at that point it's like, okay, you got to be careful now of this positive drift continuing, and then sometime by April, at least trading maybe above $130, $83 here. That can be a real risk going into April for oil. We'll skip bonds there. Crypto also holding in. Wow, those are some big bottom wicks that are kind of being held up right now. Again, I don't think FOMC is going to hurt Bitcoin all too much. I'm guessing some people who are highly reactive and don't really know what Bitcoin's all about are like, oh, the FOMC just held rates at their current pace. Time to sell Bitcoin, and Bitcoin might fall a few $1,000s. And then if any asset I think has the best chances of recovering on a dip post FOMC, I think it's probably going to be stuff like Bitcoin and gold. Oil probably will see some more continuation, in my opinion, as well. The currency side of things has a bit more nuance to it and a bit more work to do. So I think there's more risks in the currency space of more dollar strength than in other assets you might see. And let's check out the ES and the NQ. The NQ did not hold up all too well. So NQ might get slapped to like 18.1, 18. Again, it's about future expectations that will drive how low NASDAQ and the S&P go. And I don't see future expectations getting more bearish from here, at least from the FOMC. I don't think they're going to accelerate their hawkishness and only, price in their dot plots one cut. I actually think, and I'll summarize what I said in the last stream, which was that I think that the FOMC on the median will price in a little more than 2 rate cuts this year. And there will be some people in those dot plots, there will be some dots in there that price for 3 cuts and some that price for 4 cuts. So I think we've kind of found the threshold for the minimum number of cuts to expect this year as 2. And that's probably under like worst case scenarios for inflation, really. Otherwise, I think we're going to see in the dot plots some people put down potentially 2 or 3 cuts this year because they're optimistic about the economic improvements that can come towards summer, throughout the second half, on inflation recovering, and on just the world kind of getting over COVID, frankly, as from the economic hit. Hopefully that's true. There's still going to be generational problems that we're going to be dealing from the decisions made during 2020. But hopefully the economy can really, on a fundamental level, not just in a price on a chart level, like on the economic level, actually start to see meaningful improvement on inflation and some meaningful improvements in quality of life going into the latter half here of 2024. That's my hope. All right, so a more generic stream today. I'm going to kind of save my energy and my thoughts for drawing these future expectations into next week. For tomorrow, I'll probably timestamp these 2 things here tomorrow as my bullets expectation on the dollar going to the first part of the week and then down into the latter half of the week. But we'll look at some more analysis and potentially some end of month stuff as well, to just kind of tickle our fancy as to like, okay, if next week turns out this way, maybe what do we do going into the end of the month? And yeah, pretty chill outside of this PPI and the little bit of news we had on oil. Pretty chill day, I'd say. All right, you guys. I'll go ahead and see you all in a bit.